Okay, hello everyone. Welcome to this week's Minervini on the Market Weekend Weekly Report, August 25th, 2024. Let's jump right in and take a look at key components of market health as we do each week. Major indexes improved to positive. Up-down volume remains positive from last week, but new highs, new lows, and individual stock participation both improved, positive and neutral respectively. Of course, the individual stock participation came on the heels of an improvement in our STEM model, which is purely stock-based. We went from the hard penny, very cautious environment reading to the cautious exposure, which means that we're ready to put some exposure on, or we've been putting some exposure on, but we haven't yet got to that easy dollar environment where things are working really, really well, but we have gotten some traction. And so there definitely the time has come to put some toes in the water here, and that's precisely what we've done. Of course, the SPY advisor model, we've had our both feet and the whole torso in the pool here for quite some time. The 33 model went on a buy signal, of course, on January 13th, and it remains on that buy signal allocation 100%. The 25 model also went on a buy signal on the 13th, but briefly went off and then went right back on November 17th. So both those models have 100% allocation right now. And if you recall, when we had this pullback, I talked about adding to your position if you haven't yet gotten in line with it, or if you had not put any money into the allocation model and you were looking to, it was a good time to start your allocation. At some point, you need to get in line with the percentage invested. And the reason why too is if you wait for a pullback to start fresh, you might be waiting a long time. If you go all the way back here and look at 1990, we got a buy signal on this model, and it went 10 years before we got a sell signal. So, and along the way, you had a few pullbacks, but in allocation, but you could see it only went down to 66% invested. You never even got anywhere near a sell signal for that entire time. So if you want to get in line with this model, you need to just bite the bullet and get to 100% invested as soon as you can. Advanced decline line hit a new high. And that's something that is significant from the standpoint of generally the advanced decline line tops ahead of the market. And so this is a good indication that the bull market is still intact. It's not over. And also that a top is probably several months out at the minimum, because usually the advanced decline line will top 3, 4, 5, 6 months at a minimum before the overall market. Also, on a shorter term basis, we came close to a thrust, a buy signal on the advanced decline line. 1.79 to 1 was the advances versus declines on a 10-day moving average basis. Now, 1.91 is our threshold. Some people use the two to one. So again, this isn't a thrust buy signal like we've seen in the past. You'll generally get these thrust buy signals too. The best ones come off of bear markets. You can see right here coming off of the '08 bear market going into '09. We got three of them actually coming off the lows. And you don't always get one, in my experience, going all the way back to the 1980s of using this particular reading and following this for the better part of 30 some odd years, that's where I've seen big corrections or bear markets. You can see also got one coming off of the 2020 COVID low, and then right here. So again, it's significant, but we're looking at a more moderate thrust signal here. But again, it's a sign in the longer term, it's bullish, but in the short term, it could mean that we're overbought and we need a little bit of a pullback or a breather. Uh, Last week, of course, everybody was focused on the Jackson Hole Fed Powell speech, and of course, he said the time has come for a policy to adjust, a policy adjustment. Didn't give any particulars as to how much the rates would be cut, but it is widely expected now that there will be a rate cut at the September 17, 18 meeting. So we'll see how the market responds to that on that date, of course. I think the market, of course, is anticipating that, and that's how we've rallied here. If you look at the Nasdaq, we've rallied up a bit here, and it's been fairly constructive because we've gotten a lot of accumulation days. We've gotten, which also coming off the lows would be regarded as follow-through day. we only got one distribution day, and it was on Thursday, and it was followed by another accumulation day on Friday. So far, we're accumulation dominant, and that's what we want to see. And when we come off of a correction low, we get accumulation dominant, we get a follow through day, we start seeing stock setups. That's where you just have to, bite the bullet and start buying some names. And that's precisely what we've done. We also saw some thrust volume here where we got that better than 10 to 1 upside volume versus downside on a few of these accumulation days. And that's also confirmation that we're launching off the lows in a pretty strong fashion. Now, again, if you take a look at the S&P 500, we haven't gotten up to those highs yet, and we have a short position that's certain by default is turned into a hedge position against longs. Of course, we need the ETF and the S&P 500 cash index to go to new highs to trigger our stop. We're very close, and it's a good chance that we'll get stopped. But being so close, I'd be inclined to just let it stop us out. We've got longs that are hedging against that. The New York Stock Exchange NYSE Composite has hit new highs, and you can see it's really wedged up that right side. Same characteristics as the Nasdaq. We've seen accumulation days, so really, a pretty bullish picture as far as that's concerned. Last week we talked about Berkshire Hathaway raising cash, and you can see as the market goes up, cash has been deployed or raised from Berkshire. But if you look back again, as I pointed out last week, we're the highest since 2004, but still there's been cash positions that have been much higher as a percentage of total assets. So with that, maybe we still have another run here. We've got the 4-year presidential cycle. Giving us a strong tendency going into second half of this year, or in the second half of this year into the first half of next year. So again, there's some bullish tendencies there. The big question now is, we've hit on a lot of these economic readings, LEI, whether you're looking at LEI and these various economic tea leaves, we've hit levels that in the past have almost always, if not always, led to a recession. So the big soft landing question is where we're at now, and that's why these rate cuts are going to be key, and economic data that comes out post rate cuts are going to be key also to see if we get a reinflation, a reinflating of the economy or not. Like I said in the past, I think if there's a chance, we can create a bubble because the market is at all-time highs here and near all-time highs. You've got housing that is still quite strong. So the Fed has a balancing act here. You've got unemployment turning up here, and it generally moves inverse with the stock market. So definitely a weird mix of variables here, and that all stems back going to the COVID decline, which the pandemic really sort of put everything out of whack. Historically, you look back, and there's very few periods that got so distorted. 87 distorted things technically very much around the World War II, 1945-ish. You had a distortion in some of the economic readings, the way they typically or historically meshed with the way the stock market moves. But when you boil all this down, it really comes down to that Goldilocks economy and whether we can keep moderate growth and keep it sustainable. That's what we've seen in the past that have led to these long bullish periods or secular bull markets. So that's what we'll be watching carefully to see if that gets disturbed, and more importantly, the way the market is digesting or responding to these economic data points. Looking at the IBD 85 index, and I really like to key in on the stocks. And if I'm going to look at indexes, I like some of the IBD indexes because they represent the type of names that I would generally traffic in. The 85 has moved off the lows here and is wedged up the right side. And I think if you look at the 85 or if you look at the IBD 50, you see both give you a picture where, generally speaking, we may need to put in a little work and have a little pause on the right side here and build some pivots. But that doesn't mean that you wait. There might individual stocks, leading stocks will set up and could have perfect setups that are set up right now. But generally speaking, I think, over the next, week or two, This is where you can get those right sides building, and that's where you're going to get some opportunities. And so I would keep your eyes peeled very carefully right now for the next setups. And if you haven't already gotten invested, you should be looking to at least take some pilot buys and start getting in the market. So On Holdings, of course, the sneaker maker, is one that we recently bought, and we bought it in the Minervini Select trade portfolio. It's really coming out of a picture perfect recent IPO base, which we would always look to buy if we have a stock that's an IPO and sets up like this, particularly with the type of fundamentals and product cycle that they have. This reminds me of a similar stock that I traded, which was called LinkedIn. Some of you might remember this. You can see how it goes. It goes public here, it goes IPO, and then it goes to a very volatile period, but then tightens up on that right side, and that's where you start building that base. You're now in an uptrend, and although it was an IPO, it took some time before it got itself to tighten up, and got itself in that uptrend. And sometimes even the fundamentals will need to catch up to the stock price. That was the case with Facebook. Facebook also came public and had a big decline. I don't know if it was 50 or 60%. And then later on started moving up that right side in a similar fashion to LinkedIn. And then those earnings started coming in, and the fundamental picture started to coincide with the price, and you got that. The rest is history, a big move. But this is a similar type situation to the ONON play here. I know I did have some questions about whether it was set up on the right side or if it was short. No, this is quite perfect. I mean, it really is. And again, it may not work, or it may stop us out and have too much volatility to stay on the horse. But certainly, this is one that we're going to play pretty much every time when it sets up this way. The other one is this Sweetgreen, which SG is the symbol. Now, this one had earnings, and it had a gap up. We did more of a post earnings gap play on this, and again, it's a more aggressive type buy. You had the earnings. It consolidated just for a couple of days. And at that point, if it just keeps going, I'm going to leave it alone. But I got a little pullback here, and if it's really, really as strong as these earnings suggest, this should probably be the low. Maybe if the market comes in, maybe this has to bounce around, and it might shake us out. That's why we want to trade from a really, really tight stop, because then, if we get knocked out, we have maybe another one or two tries, and we don't even equal a full stop that we might take on a play that was set up, but we're giving it more room. So that was a little more aggressive play, and the reason why I made this aggressive play was because of the earnings, the strong earnings, and particularly the response to the earnings, the strong response to the earnings, and that's an earnings gap continuation play. A more classic type play for me would be something like Wing. Wingstop came through a little cheat area here. I mean, this is really, just picture perfect. You got really strong earnings, huge margins, great sales, had a correction, came right through that little cheat area right there. You could look at this as a low cheat right here. You can see it was on risk and TPR, it was green, but you were still under pressure, and that will happen. As I pointed out, sometimes you can even get the buy risk will be maybe yellow, and you'll be under pressure red. You might even be yellow in TPR, and you get that really low cheat, but you still have a lot of overhead supply, and it hasn't come up that right side or built out enough, and these gauges will still recognize that and put you on the cautious. But here we built the right side out, and this is just picture perfect. Again, I'm going to pretty much take a trade like this every time. It doesn't guarantee that it's going to work, but certainly we're off to a good start. Volume was up there. There's a number of names that are setting up. I wouldn't say the list is huge, and I wouldn't say that our traction is stellar, but we do have enough traction to add some positions. We got pretty aggressive in the Minervini Select trade portfolio. We did do a discussion on that on last week, just prior to the Q&A with Mark and Brandon. We did a session on the MSP portfolio. And during that session, I talked about how, yes, we got aggressive and got to an almost fully invested position very quickly, but from a very low risk standpoint. And I went over that in detail. If you haven't watched that, it's in the It's in the archive, and I would suggest that you watch that. That was, I think, an important discussion if you're learning about exposure and progressive exposure and position sizing. So to summarize here, is the correction over? Well, it looks like we got a low. I mean, it does look pretty bullish right now. Could it be a head fake and a bear trap? Maybe. Maybe we moved to new highs here and then we rolled over. That was the case in 2021, but we had made a much bigger move. There was much bigger divergences. But you'll see very soon after some new highs in the market, you would see a big distribution day, and you'll probably see stocks failing these recent breakouts. So we'll get a lot of indications of that. It won't be like it'll happen, and we won't notice it. That's for sure. Long-term trend is still intact. Our own SPY model, just on the S&P 500 itself, tells you that. But we're accumulation dominant. We're overbought in the short term. But again, we are seeing setups. We're seeing some setups. We're getting some mixed results, but we do have traction. We have some traction, and although it's not great traction, and we don't have profits big enough to justify giving big stops, and that's why we're coming into these positions from pretty. Pretty tight risk, enough though to get invested and to start ramping up that exposure. I would watch the leaders, watch these leading stocks, these ones that broke out and the stocks that are in like the Minervini Select portfolio, of course, and our recent platform buys, those should hold up on balance. If we pull back here and you see everything falling apart, well, then you're going to have to raise cash. But what should happen if this market is indeed healthy is you won't get many stops hit. There's been times where I've gotten no stops hit, during a pullback, a pretty decent pullback. So let's see, let's take it day by day and let's see how these recent breakouts hold up, and if we can follow through, and again, I think we may have smooth sailing until we get to the September rate decision, and then we'll have to see if it's a sell the news, buy the rumor, sell the news event. That's the next thing that we might be hit with, where this, because the market's going up in anticipation, and this has been probably the most telegraphed rate cut in history. I was just talking to Mark Ritchie the other day and saying that at one time they would just cut rates, like you wouldn't have any warning whatsoever, just all of a sudden the news would say, yeah, the Fed cut rates today 0.5 point, and the market would explode, and it just wasn't baked into the cake. And then we got into this sort of language and press conference. This press conference has actually become like a monetary policy, and to me, it's pretty much one of the same. But again, this is why we may be in a situation where they sell the news, and that's, again, we just have to watch the response to the news. That's what's more important than the actual news itself. Of course, next week, as each week I point out here, we'll have live Q&A, which is tomorrow, myself and Mark Ritchie at 11:30 a.m. Eastern Time. For those of you who are new, we do this every week. Tutorials we try to do each week when we can, or when there's a reason to. I'm not sure this week if we're going to do any tutorials, but we may. But if not, we still have Thursday live Q&A with Mark Ritchie and Brandon Hedgepath, of course. And we'll see you tomorrow. Hope you had a great weekend, and we'll see you in the morning. All right. Take care.